U.S. banking system is in its worst crisis since 2008. Here's how we got here. Last week, Silicon Valley Bank announced it had lost $1.8 billion from selling government securities, which are usually pretty safe. This freaked out its depositors, who are mostly venture capitalists and tech companies. They were worried they would lose access to their deposits if the bank got into trouble, because their accounts are so big that they are not protected by deposit insurance. They rushed to take $42 billion out of the bank, leaving it with an even bigger hole. That in turn forced regulators to take the bank over the weekend. The Federal Reserve and other regulators decided that the safest thing to do was to announce that all depositors would get their money back. They also created an emergency lending facility. And what that does is allow banks that need cash immediately to borrow from the Fed using their government bonds as security. That meant that they would not have to sell their bonds and lose money the way SVB had. Now other regional banks that have big accounts like SVB did and lots of securities on their books are seeing their share prices fall really quickly as investors worry that they too might go under. The question will be whether the Fed will have to issue a blanket guarantee of all deposits for all banks to slow this thing down. And it is probably likely that banks in general will see their profits squeezed because there will be tighter regulation and more competition for deposits.